Good morning, and thanks for joining us for Tecnoglass Q1 call. As always, we'll start with the takeaways for the quarter. This quarter, we were able to grow 12% year over year, which was significantly improved quarter versus what we've seen in the industry. In terms of the segments, single-family residential was somewhat stable, as we know. Some challenges at the end of 2025 made it so the order flow was a little bit slower, but now it's picking up in the first Q of this year and actually the first month of the second quarter in terms of orders build up. So we expect single-family residential to ramp up as we move along. Commercial construction was up 20% year over year. No surprise there. If you look at the evolution of our backlog, we hit another record backlog this quarter. So we are just executing on what was already a pretty significant build up on the commercial segment side. In terms of margins, as we discussed in the past, and it's been kind of a common theme for the industry, there's been some headwinds in terms of what has happened with input costs. The main one being aluminum, which has skyrocketed 48% year over year. So that's impacting raw material costs, which we are addressing with some pricing adjustments that are due to start on May 4th. The other headwinds that we are going through are FX and labor costs. FX with the peso revaluating significantly, but actually giving up some of those gains as of late. And labor costs with the once-a-year adjustments that take place in Colombia at the beginning of the year. With all of that mix, operating leverage, better pricing year over year, but also accounting for these headwinds, we were able to reach an adjusted EBITDA of 61.6 million, which was in line with our expectations and close to 25% EBITDA margins, which still we believe would lead the industry by a long shot. As we were mentioning, record backlog of almost 1.4 billion. We'll go into more detail there. The excess cash flow that we continue to generate allowed us to continue doing some repurchases. During the quarter, we did about almost 17 million in repurchases, which brings us to about 157 million of buybacks in the last 18 months or so. Finally, we're moving on with the redomiciliation of the company from the Cayman Islands to the U.S., which we believe that will open up some excess investments in terms of ETFs and other investors that have a U.S. domicile company mandate. Moving on to the second slide, the backlog is an all-time high, up 19% year over year and 5.5% sequentially. What is encouraging also is that it is a much more diversified backlog. Obviously, as we all know, Florida has outperformed the rest of the U.S. for the last few years. And now we're seeing a pickup in activity in some other states, with backlog almost accounting for 1/4 of total backlog, 22%. So that's encouraging in terms of how other regions are picking up, and we're looking much more diversified. Our book-to-bill continues to be over 1.1 to 1 for the 21st straight quarter, this time at 1.3 times. So we're able to replace record revenues on a quarterly basis, which is encouraging. And as we have discussed in the previous calls, the length of the backlog has extended beyond 2027. So we have visibility now for 26, 27, and building on 2028. Moving on to the single-family residential slide, as we were mentioning, it was stable year over year, but we see significant levers for growth, mainly if we look at the order levels, which were almost 4% up year over year and 14% up quarter on quarter. We're also seeing opportunities on the vinyl and other geography expansion that is undergoing at the time. Our dealership kind of growing and now being up 20% year over year in terms of number of dealers that we do business with. So more of a larger footprint for us to continue growing organically as we move forward. And obviously, we're outperforming the industry, as you can see on the next slide. That single-family residential, while it has presented some challenges in the last 2 or 3 years, we have been able to grow organically at a high single-digit rate. So that continues to be positive in terms of how we're faring against a challenging backdrop, especially on the single-family residential side. Moving on to the revenue bridge, we went from 222 million to 249 million, so a 12% increase year on year, with commercial construction, as we mentioned, highlighting the growth, 20% up versus 2025. It's important to note that there's more installation revenue as we're executing on the high-end condo market in the Southeast, which carries more installation. So while we're growing, all in all, the mix of revenues is providing somewhat of a challenge in terms of margin performance. But we continue to also grow the single-family residential side, which does not carry installation. So that should be compensated over time. As far as the EBITDA year over year, we have discussed some of the challenges going from about 71 million last year to about 61.5 million, despite having 12% higher revenues during that time span. There's a couple of main key components. Aluminum has gone up 13% just over Q4 of 2025, 48% over Q1 of 2025. So that's clearly providing a challenge. FX, in terms of the Colombian peso, has strengthened roughly 12% year over year and 3% quarter on quarter. And as we have discussed in the past, roughly 25% of our costs and expenses are into the Colombian peso. We're seeing some of that strength going back, so we'll be opportunistic in terms of how we hedge and how we manage that exposure going forward. To offset some of that, some of those challenges, we have announced price increases that will take place starting on May 4th. So that's going to help out, as well as the operating leverage that we're expecting to be created on double-digit growth in terms of top line for 2026 versus 2025. Moving forward, we wanted to highlight our capital deployment initiatives. Roughly half of our cash flow has gone towards CapEx. We have grown at a CAGR of 15-17% over the last decade. So obviously keeping up with expanding our footprint and operational capacity. Out of that CapEx, only roughly 1% is maintenance CapEx. So most of it is discretionary CapEx for us to address growth and these market share gains that we have been able to achieve over the last decade. We have been able to return significant cash to shareholders via buybacks and dividends. As I had mentioned earlier, we have almost completed about 160 million in buybacks, with about 90 million more available under the current authorization. And we continue to pay a dividend on a quarterly basis, roughly $6.5-7 million. In terms of our balance sheet, we continue to have a very strong balance sheet. Net debt to adjusted EBITDA 0.4 times. So that gives a lot of flexibility for us to move forward, to grow, to reinvest in CapEx, to potentially develop a new plant in the US and diversify operations, and invest in working capital. Obviously, as we're growing, 10-12% top line this year, that requires also a fair amount of working capital. As far as our outlook, we're reiterating guidance, going from revenues of 1.06 billion to 1.13 billion. And with that, an adjusted EBITDA range of 225 to 245 million. And we have made several assumptions in terms of what happens with tariffs, aluminum, FX, but we feel comfortable in the way that the cadence of orders and top line is going. We should be able to be on the higher side of that range. And obviously, we continue to expect double-digit revenue growth for the year. With that, I leave you and thank you for joining us for this call, and hope to see you in the next one.